The stock market is on a roller coaster. Up one day, down the next. What's going on? Why is Wall Street freaking out? It's a question on everyone's mind. Investors are rattled, and even those who don't own stocks are feeling the ripple effects. But don't worry, we're here to break it down for you. In this video, we'll cut through the noise and give you the straight facts about what's driving this market madness. At the heart of this market turmoil is the Federal Reserve, America's central bank. For months, investors have been betting big on a rate cut in September. Lower interest rates typically boost the economy by making it cheaper for businesses to borrow money and expand. This, in turn, can lead to higher stock prices. Fed Chair Jerome Powell seemed to confirm these expectations in a recent speech. His comments sent shockwaves through the market as investors interpreted them as a green light for a rate cut. This positive outlook fueled a rally, with stock prices climbing steadily. But as we'll see, the story is far from over. The latest employment figures have sent shockwaves through financial markets, defying expectations with a surprising surge in job creation. This unexpected strength has ignited a complex interplay of optimism and caution among investors and economists. While the robust job market is a boon for workers and consumer confidence, Federal Reserve Chair Jerome Powell has sounded a note of caution. He expressed concerns about potential underlying vulnerabilities within the labor market, suggesting that the rosy picture might mask cracks that could emerge in the future. Powell's remarks underscore the delicate balancing act faced by policymakers as they strive to navigate a path towards a soft landing. The market's reaction to this contradictory data has been swift and decisive. Stock prices tumbled as investors grappled with the implications of a persistently strong labor market. A resilient job market often translates to higher inflation pressures, prompting fears that the Federal Reserve may need to maintain a more aggressive monetary policy stance to cool down the economy. This outlook dampened investor sentiment, leading to a sell-off across various asset classes. As the dust settles, market participants will closely monitor economic indicators for clues about the sustainability of the job market's strength and the potential for inflationary pressures to intensify. The coming months will be crucial in determining whether this unexpected twist in the labor market narrative is a temporary anomaly or a harbinger of a more protracted economic challenge. The economic landscape is currently shrouded in uncertainty as conflicting data points paint a perplexing picture. On one hand, the latest GDP figures have unveiled a surprisingly robust economic performance, fueling optimism about the overall health of the economy. This strong growth trajectory has raised hopes of a sustained recovery and bolstered investor confidence. However, a closer examination reveals a less rosy picture in other sectors. Retail spending, a crucial indicator of consumer confidence and economic vitality, has unexpectedly faltered. This divergence between the overall economic performance and consumer behavior is puzzling economists and market analysts alike. The discrepancy between strong GDP growth and weak retail sales raises questions about the underlying drivers of economic expansion. It is possible that government spending or business investment, rather than consumer consumption, is primarily responsible for the GDP surge. Alternatively, factors such as rising inflation, debt burdens, or shifts in consumer preferences could be weighing on retail spending. As economists and investors grapple to reconcile these conflicting signals, it is clear that a more nuanced understanding of the economy is needed. Further analysis of regional data, consumer sentiment surveys, and other economic indicators will be essential to shed light on the underlying trends and identify potential risks to the economic outlook. The tech sector, long a driving force behind market rallies, has encountered headwinds as several industry titans delivered disappointing earnings reports. Amazon and Intel in particular have sent shockwaves through the market with their underwhelming performance. Amazon's results fell short of expectations, highlighting challenges in its cloud computing, advertising, and retail segments. This unexpected slowdown in growth has raised concerns about the company's ability to maintain its rapid expansion pace. Intel's earnings report was even more dire, with the chipmaker issuing a gloomy forecast and announcing significant job cuts. This news underscored the intensifying competition in the semiconductor industry and the company's struggle to regain its technological edge. The combined impact of these earnings disappointments has eroded investor confidence in the tech sector as a whole. The broader market has reacted negatively, with technology stocks experiencing significant declines. This downturn has implications beyond the tech industry, as many other sectors rely on technological advancements for growth and efficiency. As investors reassess their portfolios, a shift in capital allocation towards other sectors may occur, potentially reshaping the market landscape. Adding to the tech sector's challenges is the growing specter of increased regulation. Governments worldwide are scrutinizing the immense power wielded by tech giants, raising concerns about antitrust issues, data privacy, and consumer protection. The potential for stricter regulations could significantly impact these companies' business models, profitability, and innovation. As regulatory landscapes evolve, the tech industry faces a complex balancing act between growth and compliance. The current market landscape is a complex tapestry woven from threads of uncertainty. Conflicting economic signals, from robust GDP figures to weakening retail sales, offer investors a perplexing puzzle to solve. Overarching this is a geopolitical backdrop marked by tension, which can significantly impact market sentiment. Additionally, the specter of increased regulation for tech giants, the industry once seen as a perpetual growth engine, casts a long shadow over investor confidence. These intertwining factors create a dynamic environment where market conditions can shift rapidly, demanding vigilance and adaptability from investors. Potential market scenarios range from a sustained economic recovery with rising interest rates to a recessionary period accompanied by lower growth and inflation. The trajectory of the tech sector, as well as the broader impact of regulatory changes, will also play a pivotal role in shaping market outcomes. Given the intricate nature of the current market, staying informed about economic trends and company performance is crucial. Investors may consider seeking guidance from financial advisors to develop a personalized investment strategy that aligns with their risk tolerance and long-term financial goals. In this video, we explored the complex and contradictory signals emanating from the economy. The job market has defied expectations with surprising strength, while retail spending has shown weakness. The tech sector has faced challenges with disappointing earnings from giants like Amazon and Intel, compounded by the looming threat of increased regulation. The current market environment is undoubtedly challenging, characterized by uncertainty and conflicting data. It's essential to maintain a long-term perspective and avoid making hasty decisions based on short-term fluctuations. Diversification and a well-thought-out investment strategy are crucial in navigating these turbulent waters. For more in-depth analysis on specific sectors or economic indicators, be sure to check out our videos on Business Trailblazer. Don't forget to subscribe to our channel for regular market updates and expert insights.